I am Michael Langemeier from the Center for Commercial Agriculture. Today I'm going to talk about diversification and diversification potential, diversification strategy. So there's several reasons for a farm to diversify. I'm going to briefly talk about these three reasons. There's textbooks written on all of these topics, and so we're just going to briefly discuss each of these in turn. The one that's the main focus today is managing production risk, and so how can we use diversification to manage production risk? But also diversification is very useful to take advantage of cost synergies. I'll get into an example of that, but one of the examples is really simple. When we grow corn and soybeans in rotation, we do not need to use as much nitrogen fertilizer for that corn as we would have if we were to produce continuous corn. That's an example of a cost synergy. Also, soybean, and the reason why we don't have to use quite as much nitrogen is because we're getting some of that nitrogen from soybeans the previous year, and so that's just one example of cost synergies. I'll get into more when I talk about that a little bit later here. Also, diversification can be a farm growth strategy. So one of the ways to expand our operation is to diversify into other enterprises. Let's start with managing production risk. In general, enterprise diversification reduces income variability. And this is true even if two enterprises are very correlated. So for example, in rotation corn, rotation soybeans, they're highly correlated, meaning that the net returns follow each other over time very closely. Yes, there's years where soybeans are a little bit better than corn and vice versa, but they're very highly correlated. Even in that situation, enterprise diversification, diversifying by using a corn-soybean rotation compared to continuous corn reduces income variability. The extent to which diversification reduces income variability depends on the correlation between the enterprises. And so essentially, if you have enterprises that are less correlated with one another, that encourages you to produce those enterprises together. One example of that would be wheat net returns are not as correlated with corn and soybeans as corn and soybeans are. And so that might be one reason to put wheat into the rotation. Of course, there's other considerations when we're thinking about wheating in rotation, but certainly that is the case. There is lower correlation between wheat and corn and wheat and soybeans than there is between corn and soybeans. The classic example of managing production risk in agriculture is producing crops and livestock on the same farm. Many times the variability of the net return streams from those two enterprises are not that similar, and so the diversification is pretty powerful in that case. Examples, I've already talked a little bit about this, but let's get into some more examples. Producing both GMO and non-GMO corn for different markets. The prices is not going to be identical for those two enterprises, and so that's an example. Producing rotation corn and rotation soybeans instead of continuous corn. Crop and livestock production, spreading crop sales over time. Many times we don't think of this as necessarily diversification, certainly not necessarily managing production risk, but certainly managing risk. If you sell all your crop at one time, that's more risky than spreading those sales over several months. Using options and futures, for example, also might reduce risk, and so that's a very important risk mitigation strategy. Also, something we also might not think about in terms of diversification, this is more related to financial risk, but I'm going to talk about it here, is holding a non-farm job. Likely your wages from your non-farm job are not that correlated with your net returns from agriculture, and so that's a way of diversification. Investing in non-farm activities, putting some money into an IRA, putting money into a stock market, putting money into another small business. The returns from those activities, investment or other business activities, are not necessarily correlated with your farm returns, and so that's a form of diversification. So I've made diversification sound like an extremely powerful tool in terms of reducing risk, and it is. Don't get me wrong, it is. However, when we think about diversification, we also have to think about the return associated with diversification versus specialization. And so that's the reason why, given the potential reduction in risk in producing multiple enterprises, we don't necessarily grow all these enterprises or do all these things that would reduce risk. And so in addition to risk, it is also extremely important to gauge the potential return associated with diversification. So when we diversify, what's the expected return of that strategy? What's the risk of that strategy compared to our baseline strategy where we did not pursue that diversification strategy? And so always looking at both risk and return is the way we want to make decisions regarding new enterprises or shifting our enterprise mix. The diversified farm very well may have a much lower return than a specialized farm, mitigating the benefits associated with reduction in risk. And I want to talk about a couple cost elements right now before I move on to the next slide. Why is that the case? Why is sometimes a return for a specialized farm higher than the return for a diversified farm? Well, there are a couple different reasons. One of those is economies of scale. Maybe to garner economies of scale in crop production, producing corn and soybeans, we need to put all of our resources into corn and soybeans rather than dividing our resources between corn and soybeans and contract swine finishing, or putting up a laying barn, produce eggs, things like that. And so we always have to compare the risk and returns, from both a specialized and a diversification strategy. Also, maybe the knowledge of our operators is a lot better or a lot higher with corn production versus livestock production. So it makes sense to specialize in crop production in that case. This is an example of a trade-off between expected return and variability. This is actually a curve that was generated using 3 corn storage strategies. And so if we take a fairly low-risk strategy, it's a possibility of getting a dime increase, a dime improvement in expected return over the base case just selling in the cash market. But the standard deviation is relatively low at 0.2. As the standard deviation increases, we increase risk. If we take a more risky strategy, it's possible to get up to 30 cents per bushel higher than just a straight selling in the cash market strategy. But the risk is 3 times what it was in the strategy where we were only getting a dime. And so as we increase expected return, we're increasing risk. And different individuals are going to be different places on this risk-return trade-off. If a person's relatively risk-averse, they're going to be towards the lower end of this curve. They're going to be looking at that strategy where they might get an additional dime over the base case. Someone that's a little bit less concerned about risk may be interested in that strategy or strategies. It could be a combination of strategies where we get 30 cents per bushel over the base case. And so where you're at on this curve really depends on your attitude towards risk. Now let me shift gears and talk about economies of scope or cost synergies. This occurs when the production of one good reduces the cost of producing another related good. So the classic example, producing crop and livestock enterprises on the same farm may increase the efficiency of labor utilization and capital utilization. This is particularly true on a smaller crop farm. They can more effectively utilize their labor, more effectively utilize their machinery, tractors, and so on by adding a livestock enterprise to that operation. Also, obviously, if we have manure, with the livestock enterprise, like we will, we lower our fertilizer costs, and so that's an example of a cost synergy. Diversification may utilize operator expertise that is currently being underutilized. That's another source of economies of scope. Let's say we've got somebody on the farm that's really familiar with growing non-GMO corn, waxy corn. Why not take advantage of that knowledge and maybe think about diversifying into the production of non-GMO corn, waxy corn, white corn, seed corn, things like that? If we have someone in the business either that had some agribusiness experience in those areas or just more knowledgeable about those markets, we can take advantage of that by diversifying into those activities. Now I want to talk about the third farm strategy related to diversification. This is a strategy that there's quite a bit written about, so I'm just going to briefly touch on this. I'm calling this the diversification strategy related to farm growth. From a marketing perspective, farm growth occurs in the following ways. The last on the list is diversification, which I'm going to talk about here. This is creating new products to sell in new or different markets. Let's look at these other examples before talking about diversification. more fully. Market penetration, selling more product in our existing markets. And so if you're a corn soybean producer, producing more corn and soybeans for our existing market. That's market penetration. Market development, creating demand for existing products in a new market. And so maybe continue to produce our corn and soybeans, but let's explore different markets for those corn and soybeans. Maybe we haven't been selling to an ethanol plant. Maybe we could expand our market by selling to an ethanol plant or looking at prices in multiple ethanol plants. Maybe we can truck our grain a little bit further and look at new markets. And so that's market development. Product development, selling new products in an existing market. That's probably closer to the non-GMO example, where it's a very similar product to producing GMO corn. And it is a slightly different market, but it's a similar market. And so that might be a good example of product development. Whereas diversification, as I indicated earlier, we're creating an entirely new product, producing a different enterprise for a different market. Do you think the diversification in this case is going to account for less risk? No. And so that's why I wanted to talk about this strategy along with cost synergies and particularly managing production risk. When we think about diversification in terms of managing production risk, managing marketing risk, managing financial risk, we typically think diversification is risk reducing. Well, in this case, where we're looking at new products for new markets, diversification is more risky than not doing these things. So let's talk about this a little bit more. This strategy is usually high risk due to the inherent risk associated with developing new products and the farm's lack of experience working in the new market. An example I'm going to talk about in the next slide a little bit is producing organic corn and organic soybeans and organic wheat. If we go back to our corn soybean farm, that's a new product. There's different production practices for those organic enterprises. We have to look at different markets. It's not the same market. If it is, we're not going to make any profit on that because organic crops are typically higher price if we can find the appropriate markets. And so that's more risky than just not looking at that endeavor. So a farm pursuing a diversification strategy knowingly puts themselves in a position of greater uncertainty. Why would they want to do that if diversification is increasing? Go back to my risk-return trade-off. There's a potential for higher return. I've done some work on this, and it's on the Center for Commercial Agriculture website. If you're willing to learn about our organic crop production, there is a potential for a higher return growing organic crops. And so we're going after a higher return, knowing that we're going to take on a little bit more risk to do that. Diversification also typically involves an expansion in human and financial resources. Let's go back to the organic corn and soybean and wheat example. We're going to have some knowledge gaps there if we haven't produced those crops before. There also might be additional financial resources, additional equipment that we need to purchase for those organic enterprises, and so that's often the case with a diversification strategy. And then a very important question here, the last point on this slide: how will the new endeavor impact the farm's current enterprises and resource use? Are we going to lose focus if we think about organic production? Is that going to cause slippage in terms of our break-even prices for our corn and soybeans that are not grown organically? Do we have the resources, the human resources, the knowledge, the labor that we're going to need to engage in these organic enterprises? So I've used organic enterprises to try to illustrate the content on this slide. That is one of the examples I did want to mention on a slide by itself. Adding one or more organic crop enterprises is a good example of a diversification strategy. Another one that's common to the Corn Belt and also Indiana is adding a vegetable enterprise. Maybe potatoes, maybe tomatoes, something like that to the farm. There is additional returns that could be garnered from adding that enterprise, but there's also additional risk. And so always think about that risk-return trade-off. Always ask the question, when I'm doing something different, this case diversifying into producing an organic enterprise or a vegetable enterprise, don't just look at the additional return, also look at the additional risk and do some what-if scenarios. What if the price for the organic or the organic enterprises, the vegetable crop, is not as high as what it has been historically? Is this still a good idea to engage in these activities? So just to summarize here, there's multiple reasons for a farm to diversify. In terms of managing production risk, diversification typically reduces risk. Also, diversification is important to take advantage of cost synergies. This is particularly important for small and middle-sized farms. Many times diversifying, you can more effectively utilize labor and capital. And then finally, diversification is a strategy if we're looking at new products for new markets. It is a strategy related to farm growth, and it's something you probably should take a look at if you're thinking about aggressively expanding your operation.